Hello, good evening. Oh, good morning, all.
Good morning, sir.
Good morning, sir.
Good morning.
Yeah, thank you. Happy Workers' Day. We need to round up today. Let's look at capital budgeting. Right. We want to look at international investment appraisal. I strongly believe we are used to investment appraisal. Investment appraisal is about evaluating the financial viability of a project. We try to evaluate the financial profitability of a project and advise management whether the project is suitable or not. In most cases, we evaluate projects using the net present value method. We compute the NPV of the capital project. If the NPV is positive, we assume that the project is financially viable. Hence, we tell management to accept the project. But if the NPV is negative, it is assumed that the project is not financially viable. Hence, we reject such projects. The same thing we are trying to do today. But we are now looking at international investment projects. Where a company is located in Nigeria, we now want to carry out a capital project outside Nigeria. You have identified a project that you want to carry out outside your country. Definitely, you are going to evaluate the financial viability of this project. You are going to compute the NPV of the project. But the project is a foreign project now. That means it involves foreign currency. Now, if the project is a foreign project, we might need to convert currency. You need to convert your naira to the foreign currency. The amount will be invested in year zero. You now invest money in year zero. You now expect returns in year 1, year 2, year 3. Assuming we invested in South Africa. The currency of South Africa is rand. That means in year zero, they are going to invest, they are going to convert naira to South African currency, rand. We now place the investment, the initial capital outlay. Okonko, as you join the class, please mute. You now place the investment in South African currency, rand. Year 1, you expect cash inflow in foreign currency. when you get your foreign currency now, you now want to determine the financial viability. There are two options open to you. You can calculate the NPV in foreign currency. You can calculate your NPV in foreign currency. In this case, you are going to discount foreign cash flow with foreign discount rates. You are going to discount the foreign cash flows with foreign discount rates. Alternatively, you can convert the foreign cash flows to your local currency. You convert cash inflows to local currency, convert cash outflows to local currency. You now use local discount rates to discount the project to their present value. All right. Whichever approach you take, you are supposed to have the same NPV if the market is efficient. What are the other issues? We have explained exchange rates. It also involves exchange rate risk because exchange rates can fluctuate, and that will affect your foreign cash flows if the rates you fluctuate. Also, there is taxation. You have placed investments in South Africa. The profit generated in South Africa, this profit may be taxed in South Africa. If the income is repatriated to Nigeria, that income may also be taxed. Now the question is there double taxation agreement? If there is double taxation agreement, where there is double taxation agreement, any income tax in foreign country will not be taxed in local country, assuming there's double taxation agreements between Nigeria and South Africa. If the income is taxed in South Africa and the income is repatriated to Nigeria, the income will not be taxed in Nigeria because there is double taxation agreements between Nigeria and South Africa. But if there is no double taxation agreement between Nigeria and South Africa, if the income is taxed in South Africa, the income will still be taxed in Nigeria. So we are going to check whether there is double taxation agreement or not. Then finally, is if you are placing investment in foreign country, you also must be aware that your investments may be exposed to political risk. Aside from your foreign currency risk, aside from exchange control risk. Aside from double taxation agreements, foreign investments is exposed to political risk. The risk that the government of a foreign country might take action that might affect your investment or can affect the profitability of your investment. Government may place restriction on the ability to repatriate your returns. Foreign currency policy may affect that investment. All right. Lastly, is that at times the foreign project may involve royalty payable, royalty receivables. Royalty payables is an expense to the company paying it, while royalty receivable is an income. David, you're on your own. Exovo. Based in South Africa, all right, let's continue. So there could be royalty. So the company paying the royalty, that's an expense. So the company receiving the royalty, that's an income. Royalties. All right. Let us look at page 143, question 1. Let us use this question to further discuss international capital budgeting. Refer to page 143, question 1. All right, we can go ahead. Let's pay attention. Google PSC is a highly successful manufacturing company operating in Nigeria. In addition to sales within Nigeria, the company also exports to a foreign country with currency $, along the ECOWAS sub-region. The export sales generates annual net cash inflows of 50 million. Google PSC is now considering okay, that's true. Play just 1 minute. Let's increase the font size. It has even increased anyway. But you are supposed to open the question on your system. Oh. Google PLC is now considering whether to establish a factory in the foreign country and stop export for Nigeria to the country. The project is expected to cost $1 billion foreign dollars to establish a factory in foreign country. That will cost $1 billion. Somebody is still asking which page. When it's on your group chat. The project is expected to cost $1 billion. That is the initial investment amount, including $200 million for working capital. Out of the $1 billion, $200 million is for working capital. Paragraph 3. A suitable existing factory has been located and production can commence immediately. A payment of $550 million will be required immediately, with the remainder at the end of year 1. That means the $1 billion, 550 will be invested in year 0. 50 million will be invested in year 1. The following additional information is available. Annual production and sales in units, 110,000. Selling price per unit in dollars, 5,000. Variable cost per unit in dollars, 2,000. Royalty payables in units to Google. That means the foreign investment will pay us royalty, 300 naira per unit. Incremental annual fees cost, incremental annual cash fees cost, $50 million. Assume that the above cash items will remain constant throughout the expected life of the project of 4 years. So the project is for 4 years. At the end of the year 4, it is estimated that the net realizable value of the non-current asset will be $1.4 billion. Paragraph 5. It is the policy of the company to remit the maximum fund possible to the parents at the end of each year. So at the end of each year, the project must remit cash return, assuming that there are no legal complications to prevent this. If the new factory is set up, an export to foreign country is stopped, it is expected that a new export market of a similar worth in North Africa will replace the existing export. So we are not losing money. If you stop the exports, we are going to get another new market and generate income of the same world. Production in Nigeria is at full capacity, and there are no plans for further capacity expansion. Tax on the company's profits is at a rate of 40% in both countries. Payable 1 year in arrears. Please underline. Tax is paid 1 year in arrears. A double taxation agreement exists between Nigeria and the foreign country, and no double taxation is expected to arise. No withholding tax is levied on royalty payables from the foreign country to Nigeria. That means royalty has escaped tax. Tax allowable depreciation is at the rate of 25% on a straight line basis for all non-current assets. The directors of Google PSC believe that the appropriate risk-adjusted cost of capital of this project is 13%. Annual inflation rates in Nigeria and the foreign country are currently 5.6% and 10% respectively. These rates are expected to remain constant in the foreseeable future. The current spot rate is $1.6 to Naira. You may assume that exchange rate reflects the purchasing power parity theorem. Evaluates the proposed investment from the viewpoint of Google PSC. So, the proposed investment from the viewpoint of Nigeria, from Naira viewpoint. Please, just 1 minute. Just 1 minute. Now let's continue with the class. Now look at the question. You have learned investment appraiser. We love investment appraiser. Most students are investment appraiser, yes. Even before the final level, we are used to investment. We want to evaluate this project from Naira viewpoint. Show your workings, calculation to the nearest million. How do you start this question? I need to evaluate a foreign project from the perspective of Nigeria investor. So leave the first page. Let us go to workings. Leave the first page. We start working from here. The first thing you are going to do that we advise is get the exchange rate. The project is for 4 years. I know the exchange rate now. You're working one. So you can take your notes the same way you copy in your physical class. My working one. Calculation of exchange rates between $F and Naira. Examiner says, now your spot rate is $F 1.60 equal 1 Naira. Please, what type of quotation is this?
It's an indirect quotation.
Thank you. Oh, Abdul. This is an indirect quote. You are now giving inflation rate in Nigeria. Examiner says inflation rates in Nigeria. Inflation rates in Nigeria 5.6%. In foreign country 10%. Examiner now gave you a clue. You may assume that exchange rate reflects purchasing power, parity theorem. What the examiner is telling you, use purchasing power parity theory to forecast exchange rate between dollar and Naira. That is what the examiner is telling you. This is indirect quotes. This is if I want to using purchasing parity theorem.
Your line is breaking.
If I want to theory, it's cool. One plus divided by 1 is equal to F over X. You are going to use this formula to forecast exchange rate for year 1, year 2, year 3, year 4, year 5. Your FI, foreign inflation, that is inflation in foreign country, 10%. Your DI, domestic inflation, that is inflation in local country, Nigeria, 5.6%. Your spot rate, X, that is the spot rate, is equal to 1.60. What is F in year 1? What is F in year 2? What is F in year 3? You now come here. 1 plus 10% inflation in foreign country. Check. 1 plus inflation in domestic country is equal to F spot rate 1.60. You now do like this. 1.1 over 1.056 is equal to F over 1.60. Now cross multiply. F is 1.1 times 1.6 divided by 1.156. Please calculate F in year 1.
$1.67.
Faith, are you speaking to us?
Yes, I said 1.67.
1.67.
I got
1.667.
8.
Something like this, Abby?
I got 1.608. 1.20.
1.67.
1.6. It's correct.
We shouldn't be get the same answer. Yeah, you have 1.67. That is spot rate in year 1. That is your spot rate in year 1. If you want to get year 2, you don't need to stress yourself. Just do F2. Pick F in year 1. Now remove this now. Remove 1 point. This is F in year 0. Sorry, this is the spot rate for year 0. This is spot rate for year 1, 1.67. If you want to get for year 2, just come here. 1.1 multiply, take this now. 1.67 divided by 1.056. That will give you spot rate for year 2. Remove what you have here now. Replace it with the new answer you get for year 1. If you work this out now, that will give you spot rate for year 2.
1.74.
1.74. If you want to guess for year 3, just come here. 1.1, this will not change. Multiply by, pick for year 2, 1.74 divided by 1.056. What is the forward rate for year 3?
1.81.
1.81. If you want to guess for year 4, remove the one for year. Come here, 1.1 multiplied by 1.81 divided by 1.056.
$1.89.
1.89. If you want to guess for year 5, although the project is for 4 years, but tax is paid in arrears. 1.1 multiplied by 1.89 divided by 1.056. Get your rate.
1.97.
1.97. You have gotten the exchange rate from year 0. You have year 0, that is the spot rate now. $1 1.60 to 1 naira. Year 1, the spot rate will be, that is spot rate in year 1. Forward rate for year 1. $1 1.67 equal to 1 naira. For year 2, please check. Please check.
1.74.
$1 1.74 equal to 1 naira.
Year 3, 1.81.
Thank you. For year 3, the spot is $1 1.81 equal 1 naira. For year 4,
1.89.
$1 1.89 equal to 1 naira. For year 5, the spot will be $1 1.97 equal to 1 naira. You have used purchasing power parity to forecast exchange rates between dollar and naira from now to year 5. We are going to use these exchange rates to convert currency to naira. I think just 1 minute. Just 1 minute. I will be back. Sorry for the break, let's continue. So in exam, examiner can give you capital budgeting question and introduce foreign currency to it. Remember to forecast exchange rate. You can either use purchasing power parity or you can use interest rate parity theory. You have finished working one. We can now go to the other transaction. Now let's start from the beginning. Paragraph 1, nothing important to me here. Paragraph 2, the project initial cost, $1 billion. Included is working capital. You are going to separate the working capital because working capital is not liable to tax. So I'll come here, my working two. My working two, let me separate. Initial investments in $, 1 billion. Examiner says to the nearest million. 1,000 million is equal to 1 billion. Out of this initial investment, included is working capital. Working capital, 200. I will need to separate this. Difference between this, that means my non-current assets. My non-current assets investment is 800 million $. Why are we separating this? Capital allowance will only be calculated on non-current asset investment. You don't calculate capital allowance on working capital. So there is need to separate. Next. Next. Paragraph 3. Examiner says a suitable factory has been located and production can commence immediately. A payment of 950 will be required immediately, yes, sir. The balance of 50 million to be paid at the end of year one, no problem. When we get to the project proper. Next, the following additional information is available. Annual production and sales in units, 110,000 units. unit selling price is $5,000. Unit variable cost, 2,000. We can calculate this. We can calculate this. Our annual revenue, working 3. My working 3. Okay, this should be working 2. Working 3. Annual revenue. Annual sales is 110,000. Selling price per unit, $5,000. Please multiply. $550 million. Our annual sales revenue. Annual revenue. But we are going to break it down, please. You are going to see the reason. Annual revenue. Annual revenue. Oh, no more space. Okay. We got to create more space. So hey, just hold on. I have to cut this down now. Let's just hold on. Let me take this off first. Otherwise, got to deal with this. You come here first. Then let me expand this. One more. Okay. Now let's go on. Your year 1, year 2, year 3, year 4. Revenue in dollars, $550 million. F dollar, $550 million. F dollar, $550 million. F dollar, $550 million. This is the revenue we are going to get annually. Our variable cost annually. Variable cost annually 2,000 multiplied by variable cost per unit. The variable cost per unit is $2,000. We are going to produce 110,000 units multiplied by variable cost per unit, 2,000. Annual variable cost, F dollar, 220 million. Again, you are going to spread it out. Year 1, year 2, year 3, year 4. Variable cost in F dollar, 220 million, 220 million, 220 million, 220 million. We are trying to get the cash flow from that project. The project is in foreign country. We are going to get revenue year 1 to year 4. We are going to incur variable costs year 1 to year 4. Royalty payable. Working for calculation of annual royalty. Look at the question, please. Naira per unit. Able to Google PSC annual royalty pay. The line is back. Let's continue. The foreign country will pay Google royalty. This is in Naira. Annual royalty payable per unit is 300 Naira. So we are going to produce 110,000 units multiplied by 300 Naira per unit. That means annual royalty is in Naira 33 million. This royalty is in Naira. We need to have it in dollars. This is in dollar. We need to take this back to dollar also. You now come here. royalty payable in F dollar. You have your year 1, year 2, year 3, year 4. In Naira is 33 million. 33 million. 33 million. 33 million. And I need to convert this to dollar. Exchange rate for year 1, 1.67 F dollar. For year 2, 1.74. For year 3, 1.81. You can see the importance of this rate now.
Yes.
For year 4, 1.89. You now get royalty payable in F dollars, in million. Now, let me ask you. You know we are giving indirect codes. From the angle as a Nigeria, this code to me is indirect. Assuming you are in foreign country now.
It will be direct.
It will be direct. Assuming you are based in the foreign country, their code to you is direct. Naira to you is foreign. So imagine all of us were in foreign country now. Their code to us is direct. Naira is a foreign currency to us. Dollar is our local currency. Now you now want to convert foreign currency to your local currency, giving direct codes. Are you going to multiply or divide?
We are going to multiply.
Direct you multiply. Okay. For you to get this back now to dollar, multiply 33 by 1.67.
55.11.
Please, to the nearest million. 55 million. Again, multiply 33 by 1.74.
57.
57.
57 million. Again, multiply
60
by
million.
60
million.
60 million.
Next, the last one.
62.
62.
62 million. You have taken Naira back to foreign currency. So you are going to try to look at it. Assuming I'm in foreign country now. That means dollar is my local currency. Naira is my foreign currency. I will now need to.
So, sir.
It's not a direct quote to me. In that case, if I want to convert Naira to my local currency, since I'm giving direct quote, I will need to multiply. All right, that's fine.
But sir, this assumption, is it only peculiar to when you are calculating annual royalty?
No, please, it's not peculiar to this question. Any questions that involve you to move from, you are moving from local to foreign now.
Yes.
You are moving, Naira is local to you. You are moving to foreign now. So it's not peculiar to this question only.
Okay, sir.
we continue with our workings until we are satisfied that we are taking all the workings. Incremental annual cash fees cost, we take it later. Assume that the cash flow will remain constant throughout the expected life of this project. That's fine, no inflation. At the end of 4 years, it is estimated that the net realizable value of the non-current asset will be 1.4. This is the residual value. We come back to this. It is the policy of the company to remit maximum sum. Okay. If the new factory is set up and export to the foreign country is stopped, it is expected that new export market of a similar worth in North Africa will replace the existing export. This is fine. Now, this information, let me explain it. Look at information 1. The export says we are going to lose it. If you open a factory in foreign country, we are going to stop exports to that foreign country. We are going to lose. Normally, we generate cash inflows of 50 million. That means if you stop the export, we are going to lose 50 million naira. This information is relevant, but examiner now create another point here. Examiner said, if the new factory is set up and export to foreign countries stop, it is expected that a new export market of a similar worth in North Africa will replace the existing export. That means if we lose that 50 million, we are going to get another export in North Africa that worth 50 million. So we are not losing money. Production in Nigeria is at full capacity. And there are no plans for further capacity expansion, meaning we must set up foreign country. Taxation is 40%. There is double taxation agreement between Nigeria and foreign country. That's fine. No withholding tax on royalties. We come back to this. Now look at this. Tax allowable depreciation is at 25% on a straight line basis for all non-current assets. Compute tax allowable depreciation. This is calculated on non-current assets. Look at it. You don't calculate tax allowance on capital, on working capital. You are going to calculate your tax allowance on 800 million. 25% of 800 million. That is annual tax allowance. Working 5. Calculation of annual tax allowance. Annually is 25%. compute 25% of F dollar, 800 million. That will give you 200 million. That is our annual tax allowance. Annual tax depreciation. Now, for a year, calculate annual tax savings. Your tax allowance, your annual tax depreciation is to reduce your taxable income. It is meant to reduce the tax paid. In this case, determine annual tax allowance. Annual tax savings. Annual tax savings. You are going to get allowance of 200 million. What is the tax savings?
Oh my goodness.
Now, what is the tax rate?
The tax rate is 40%.
Oh, thank you. This is in F dollar, please. This is in dollars. So our annual tax savings, with the capital allowance, 200 million, multiplied by the tax rate, 40%. That should give me 80 million. Am I correct?
Oh my God.
Hello, sir. Somebody is trying to say something to you.
Who is the person?
It's me, sir.
Please go ahead.
Okay, where did we get the 800 million for the current assets? For the non-current assets?
Look at it here. Working what self? Working two. Initial investments. 1 billion.
Yes.
Working capital. 200 million.
No.
And I said, you don't calculate capital allowance on working capital.
Okay.
Examiner says your initial investment required is $1 billion.
Yes.
This includes 200 million of working capital.
Oh.
You are now going to remove the 200 million from the 1 billion. That balance is non-current asset value.
Okay, sir. Thank you.
All right, you're welcome. So you can get your cash flows now. Let's go get our cash flows. Calculation of net cash flows and MPV.
Sorry, sir,
Let's see how
I
it
see the
goes.
tax save calculation. It's scrolled up.
You have your year.
Hello, sir.
Yes, please.
Please, I didn't see the tax save calculation. It's scrolled up.
I can hardly hear you.
I did not see the tax save calculation, sir.
Cash flow.
Tax save, tax save.
It is tax save. And we
Yes.
have calculated it now.
The tax rate, the 40% of 200 million. She
You have
said
the question with you. Tax rate. So you can look at it. Tax rate there, 40%. So you have year 0, year 1, year 2, year 3, year 4, then you have year 5. You know the project is for 4 years, but we are going to need year 5. First, the transaction will be in your revenue in F dollar, 55 million. All figures are in million, 55 million. 55 million. Year 1 to year 4. Why you have year 5 is because tax is payable in arrears. You have variable cost. Also in F dollar, 220 million. Your variable cost also in F dollar, 220 million. 220 million. 220 million. Your fees cost, cash, fees cost, also in dollars, annually 50 million. 50 million. 50 million.
sir, you're breaking.
50 million.
Your voice is breaking, sir. And the
This
screen.
project we pay royalty. 55 million. Madam, anytime this thing breaks, no, that is not me that is breaking. No. It's actually network. Assuming you are doing this lecture too, at some point your network will fluctuate. If I have control over it, I don't break when I'm speaking in class. But the variable you are talking about is not within my control.
I know, sir. I'm just telling you.
I know. You know you have been saying this consistently.
No, I've not been saying it, though.
Maybe you don't know. You have said it before. I just ignore. Maybe you don't know. I know you said this. I just ignore.
Oh,
if
I'm
you
sorry.
to work, the network is really bad. We shut down the class and move on.
Sir. I'm sorry, sir.
I'm just being factual. You know, when you come to business, certain things not within your control. I try to switch from MTN to Airtel to, they are just moving around the way they like.
Child, don't mind it. Wait, I need clarification on something, right?
Is to just explain that play that is breaking.
No. It's about whenever I notice something in SFM, whenever the question says that tax is paid in arrears, if the project is supposed to be a project of 3 years, we will usually add an extra year, like the 4th year.
Of course.
Okay, that's the standard, right? Because you've done it now, and the other lecturer used to do it too.
And now you know when you say you are paying in arrears,
Yes.
that means tax for year 1 will be paid in year 2.
Okay.
Tax for year 2 will be paid in year 3.
Okay.
Tax for year 3 will be paid in year 4. That means the tax for year 4 will be paid in year 5. For that reason, even though the project is for 4 years, because we are paying tax in arrears, we need to bring in the 5th year.
All right, sir. Thank you.
Foreign currency. Now your royalty for year 1, royalty for year 2, 57, year 3, 60, year 4, 62. Royalty paid. If you observe, all these cash flows are in foreign dollar. Now get the difference. You are going to generate revenue in dollars, variable cost paid in dollars, fees cost paid in dollars, royalty paid in dollars. Get the difference. This will give you what we call cash profits. Cash profits in dollars. We call it cash profit because we didn't deduct depreciation. Now get your cash profit.
225 for year 1.
225.
223 for year 2.
223.
Year 3, 220.
220.
And 218.
218. Once you get your cash profit, calculate tax you are going to pay. You are paying tax in foreign country now. All these transactions happen in foreign country. The foreign country will collect tax from you. Pay tax. Now remember, tax is paid in arrears. 40%. 40% of 225.
90.
90. We are going to pay in year 2, arrears. 40% of 223.
89.2.
We are going to pay in year 3, arrears. 40% of 220.
88.
We are going to pay in year 4. 40% of 218.
87.
This will be paid in year 5. This is why we require year 5. As soon as you pay your tax, please go and claim capital allowance. Sorry, go and claim tax savings.
Tax saved on
Capital allowance.
allowance. Yes, sir.
Tax saving on your capital allowance. And please note, your tax savings on capital allowance will follow the tax rule. Tax is paid in arrears. Your tax savings will be claimed in arrears. The tax savings for year 1, 80 million, to be claimed in year 2. It's a tax saved. It's an inflow. The tax saved in year 2, 80 million, to be claimed in year 3. The one for year 3 to be claimed in year 4. The one for year 4 to be claimed in year 5. your capital allowance will follow your tax rule. If the tax is payable in arrears, capital allowance and tax savings will be claimed in arrears. You now introduce your initial investment. Initial outlay. Examiner say in year 0, we are going to invest $550 million in brackets. The balance to be invested in year 1. I hope you can see where we have this information. Let me refer you to it.
Of 950 million will be required immediately.
Look at this. A payment of 5 million will be required immediately, with the remainder payable at the end of year 1. So that 1 billion, we are going to pay 550 million in year 1. In year 0, balance to be paid at the end of year 1. This amount includes your capital allowance. This money includes capital allowance. At the end of the project, capital allowance will be recouped. Yes, tell me.
Okay, sir. So the part that says that this suitable factory, so I thought the cost for the suitable factory was 950 million, that we needed to pay 950 million for this factory at the moment.
The whole factory is 1 billion.
Then if the whole factory is 1 billion, then I feel like the whole 1 billion should be, I mean, factory is a non-current asset, right? So if we are getting the whole factory for 1 billion, then why are we just saying it's 800 million that is for non-current assets?
Did you have the question with you?
I do.
Yes,
I know at the beginning of the questions, it says that the entire...
think it's the working
Please,
capital.
speak? Somebody is speaking. You cannot jump into that talk.
Yeah, I know that it says that the entire project is
I'm
one.
not even talking about you. I'm aware you are the one that want to speak. But somebody jump into the talk.
Sorry, I think he was trying to explain to me. Can I go ahead, please?
Yes, but let me go ahead.
Yeah, so I understand at the beginning it says they need 1 billion for the entire project, which including 200 million working capital. Yes, but this other paragraph, I don't know, maybe it seems to confuse. Like if you are saying that you want to buy a factory for 1 billion, then factory is the non-current assets.
Are you done?
Yes, I am. Thank you.
The suitable factory has been located. And he now said a payment of 950 is required in year 0. He didn't tell us the factory is 950 billion. He only said we are going to pay 950 at the start of this project. This 950 includes payment for factory and the working capital.
Okay. Thank you, sir.
So my point now, sir. Yes, my point is, yes, I'm interested in how we treat the working capital aspect of the cash flow.
Okay, how do we treat it now?
Yes.
First, you separated, right?
Yes.
Out of this 1 billion, you remove 200 million. Is that not? Now,
yes.
Look at it now. It has been treated now. The 200 million is part of the 1 billion, Abby. That
Yes,
means
you were
out
saying
of
we
this
will
950
recoup. Okay, you were
and
saying
this
we will.
50 million, working capital has been embedded.
Yes, I know. You were saying we will recoup at the end of the project. I thought you wanted to say
Yes.
we will recoup that working capital, but you said we will recoup the capital allowance. That's what confused
No,
me.
that should be an error.
Okay,
You
that's
don't
fine.
recoup capital allowance. So we are going to recoup our working capital unless the examiner states otherwise. You now come here. Working capital recovered now. Remember, the project is for 4 years. So the project will end in year 4, not year 5. So you are going to recoup 200 million here. Working capital recovered or recouped. Lastly, examiner gave us something here. Examiner says at the end of the project, it is estimated that the net realizable value of the non-current assets will be 1.4 billion. That means at the end of the project, you can sell the project to realize 1.4 billion. That's an inflow to the project. I will come here. Net realizable value. Net realizable value. I can get 1,400 million. If I sell the project in foreign country, I can get 1.4 billion. Now, if you sell this project, won't you pay tax? Yes. Yes, see. Am I correct? Or yes, sir?
Yes, sir. Yes, sir. Sir, I have a question regarding this net realizable value, which is the scrap value.
Regarding what, please?
Regarding the net realizable value.
Okay.
So when we are computing for the tax saved on capital allowance, we did not consider it by removing it from the cost of the non-current assets. So, like, I want to ask, is it that way we are going to do it by not putting it into consideration when computing tax saved on capital allowance?
Okay, I understand what you are saying. Why is it that we didn't consider it at the point of calculating our capital allowance? You have options.
Yes, sir. Yes, sir. That's my question, sir.
Residual value. The cost of the asset, 800 million. Residual value is 1.4. Residual value is 1.4. That means an alternative and safer approach to you is treat your capital allowance first. That authority will treat that 25% on non-current assets. Now come back. Take your residual value. Now when you now take the residual value, because we have not considered tax, assuming we have done that we have deducted in what's it called? From the initial cost of the asset. We don't need to calculate tax again. But now, pick the old figure. Now tell yourself, if I million, who can pay tax? Now come here. A saver approach. Now says tax effects on realizable value on this 1.4 million. It's assumed now that you have sold the asset, you realize 1.4 million. And you have claimed all the capital. Oh, Faith.
Yes, sir. Sorry, just a quick one. The working capital received, why did we put it in year 4?
Okay, I will answer that. That's even minor.
Thank you.
That one is even minor, sir. So you assume that you have claimed all your allowance. You don't have allowance again because you have claimed allowance for 4 years. You now sold the assets for 1.40. You know you are going to claim allowance in year 1, 200 million. Allowance in year 2, 200 million. Allowance in year 3, 200 million. Allowance in year 4, 200 million. At the end of the project, you now have zero. You have zero, we call it tax written down value of your asset is now 0. The way the tax authority will do it for you is that it's going to do like this now. Look at what will happen now. Faith, I'll come back to your question. It's a minor question you asked.
Okay, sir.
I'll come back. Look at what will happen. The tax authority will do like this. Your capital allowance. Capital allowance. Your non-current assets. Non-current assets. 800 million. Year 1. Year 1, you claim 25%, 200 million. You have 600 million. Be looking at it to straight line. You know a straight line. Year 2, you also claim 200 million. You have tax written down value 400. Tax written down value. Year 2, 3, you also claim 200 million. You have 200. Year 4, you also claim 200 million. Your tax written down value is now 0. You now sold the asset for 1.4 million. Because you have claimed allowance for 4 years, the tax written down value of the asset is 0. The asset is now disposed for 1.40. This will now give rise to what we call balancing charge. On this 1.4, you are now going to pay tax of 40%. Yes, sir. Is it better, please?
Yes, sir. Now, I understand you, sir. Thank you, sir.
You just move on to that. But you don't need to go through this long route. Examiner says straight line. That means I must claim the same amount every year. At the end of year 4, my tax written down value will be 0. If I should sell the assets for 1.4 billion, Then that will become my balancing charge. I will now compute tax on balancing charge. If you calculate tax on your balancing charge, 40% of 1.4, what do you have?
560.
That will be paid in year 5. Tax is payable in arrears. I will now return here. Say, please, just 1 minute. The tax effect on my this, you just put it here in year 5, 560. Tax. Now, back to Faith's question. This amount in year 4, because the project is for 4 years, we only have year 5 because we are paying tax in arrears. Our project is for 4 years. What gives rise to year 5?
Tax paid in arrears.
It's because of 1 minute. What gives rise to year 5 is because the tax is payable in arrears. You can now get your net cash flows. Net cash flow in F dollar. Yes, Usman.
Yes, sir. What of the proceeds from the sale of the business? How do we treat it, sir, in terms
Which
of cash
business is
flow?
that?
The business we are selling at the end of year 4. What of the
Have we not
proceeds?
treated it? We
The
have
actual
brought it in here now.
Okay.
1.4 billion. Just
Okay.
1 minute. We have Usman, is that better, please? We have treated it now.
It's clear,
We
sir.
brought
Go
in the
ahead, sir.
1.4 million here.
Okay, it's clear. Go ahead, sir.
Now get your net cash flow. You are going to start addition from your cash profits. You are going to start to add from here. Year 0 is 950. Year 1, add. You are going to start your addition from your cash profit. Addition and subtraction. Year I have 950. Year 0, 950. Year 1, 225 minus 50. That should be 175. 175. Year 2. Please add 223 minus 90 plus 80.
213.
213.
211.
211. Which one am I taking? Okay, this is 213.
Yes.
213. 211. My year 4. How many variables here? 218 minus 88 plus 80 plus 200 plus 1,400.
1,810.
1,810. Year 5 minus 87 plus 80 minus 50, 560. Negative. Minus what?
567.
567. Now you have gotten the net cash flow in dollars.
Discount factor.
Okay, Obafemi, I'll come back to your question. Kindly recap on how you get the 560. Hey. Okay, quickly. Obafemi. Is the tax paid on net realizable value. Compute 40% of 1,400.
Okay, thank you, sir.
So if you are looking at it, tax effect of net realizable value. Okay, you can't bring in discount factor here. Examiner says you should calculate, evaluate the project from the viewpoint of Googie. Googie is a Nigerian company. That means you need to convert this, net cash flow in dollar to naira. We need to convert all this to naira now. Now introduce exchange rates. Exchange rate. Here is 1.6. That is spot rate in year 0. F dollar to 1 naira. Year 1, 1.67 spot rate. Year 2, 1.74. Year 3, 1.81. Year 4, 1.89. Year 5, 1.97. Go and look at working one. You have gotten the net cash flow in dollars. But examiner says evaluate the proposed investment from the viewpoint of Googie PSC. Googie PSC is a Nigerian company. So examiner wants you to evaluate the project from the viewpoint of Nigeria, a Nigerian investor. We now need to convert this dollar to naira. Again, now look at it. You are now in Nigeria. You are going to receive cash flows from foreign country. You now want to convert to your local currency. And you have indirect costs.
So you divide.
Are you going to... Yes, go ahead.
You divide based on the indirect costs.
Okay, yeah. Charity, I thought you want to say something.
I was saying you would divide.
Aha. You need to divide now to get the cash flow in Naira. We are get cash flow in Naira. Net cash flow in Naira. 950 divided by 1.6.
Minus 594.
594 negative. Divide.
$105.
105. Divide.
122.
122.
117.
117.
Nine five
958. Why did you pause? Are you not sure?
No, my sister was playing music, so I had to tell her to stop that.
958. The last one.
Minus 288.
Negative 288.
Someone should confirm.
Who will confirm? They are just following you now.
You are correct, actually.
Confirm it.
Present value.
Wait. Let me do something. I'll need more space. We have gotten the cash flow. We have gotten the cash flow in dollars, in Naira. I'm trying to get more space. I needed more space to work with. At least more. Let me see if I can get more space. And there's more space to work with. Wow. But are we done? Remaining just more. You have gotten your cash flow in Naira. Play just 1 minute. I just needed this small space to round up the question. All right, I think this should be enough. But let me keep it in case it's not enough. Let me expand small. Okay. Okay, come here. Permit me to put the year again now. Have the year 0, year 1, year 2, year 3, year 4, year 5. So we have gotten remittance now in Naira. Our remittance from foreign projects. The net cash flow as remitted by the foreign projects. We have MPV in Naira, 594 in brackets, 105, 122, 117, 958, and 288 negative. Now don't forget, there's what we call royalty payables. The foreign projects paid royalty to Googie. It is payments to the foreign projects. It is income to Googie PSC. Now come here. Royalty received. Royalty received. Let me refer you to it. And look at it here first. Unit royalty payable to Googie. That means Googie receive it. It was paid by the our foreign projects. It's an expense to the foreign project. It's an income to Googie as an investor. In addition to cash flows, Googie also receives royalty per unit produced. That means there's additional income to Googie. Yes, Madam Pelumi.
Okay, this is quite confusing. Googie is the one carrying out the project abroad, if I understand correctly, right?
Yes.
So why they're paying royalty to themselves? I mean, they are the one carrying out the project, and I thought they are paying royalty on the product. So who is paying Googie since Googie is the one carrying out the project?
All right. Do you log on with 2 devices?
Yes, I did. I use my laptop for a better screen.
Why?
I mean, for a wider screen. I use my laptop for a wider screen.
All right. Now look at it from this angle. You are based in Nigeria. You have a company in Nigeria. You now open a franchise in Ghana. You are the producer of this product in Nigeria. You are the producer. You now open a franchise in Ghana. They will produce your label in Ghana. Your brand label will be produced in Ghana. You now tell them that for every unit you produce, you are going to give me a royalty of 300 naira.
That's clear. But why isn't that an expense in the first place?
Wait now, let's be taking it. Okay. So the two companies are independent. Dangote Nigeria, Dangote Ghana. They are two companies. Although we know that the same owners, the person that owns Dangote Nigeria also owns Dangote South Africa or Ghana. Dangote cement is produced in Nigeria with a label Dangote cement. The brand is known worldwide. You now say, okay, open Dangote Ghana now. A company independent. You now ask them that you are going to produce cement. For every cement you produce, with a label of Dangote now, you are going to pay us a royalty of 300 naira. That means to Dangote Ghana, that's an expense. To you in Nigeria now, that's an income. Oluwapelumi, are you there?
Yes, I am. It explains it, but are we saying that so if we just ignore that one, since it's like come and go out, would it actually affect our calculation? I'm just thinking. Since it's like the expense, the revenue you just net off.
Oluwapelumi, now that you know, don't ignore it.
Okay.
If you ignore it, it will reduce your mark.
Okay, sir. Thank you.
Yes, Mr. Usman.
Yes, sir. As Pelumi said, it looks like removing money from your right-hand pocket and putting it in your left-hand pocket, while you are still standing as the same person.
It's not. You know, each company, if you remember when you are doing divisional performance, each company is an independent company. Each company is an independent company. You know, you can also produce cement without my label. You know, it's possible. You can produce a cement without Dangote label. What they are trying to tell you technically is that, look, Dangote label has a brand. It has what we call goodwill. So anytime you are using our name to produce cement in Ghana, pay us royalty. So you are going to be paying them to Nigeria for every unit you produce. So the appropriate treatment. What is expense to the foreign partner is income to you. So your appropriate treatment will now be, we now bring in here. So don't choose to ignore it. In Naira, royalty received 33 million. 33 million. 33 million. 33 million. The project is for 4 years. Production will run for 4 years. So don't go to year 5. Now go and look at the question very well. This royalty received as escape tax. Look at the last paragraph here. No withholding tax is levied on royalty payables from foreign country to Nigeria. That means this income has escaped tax in foreign country. This income will be subjected to tax in Nigeria. This 33 million, you are going to pay tax on it because no withholding tax is levied on this money. And the money has now gotten to Nigeria. You now compute the tax rate, 40%. Examiner say tax rate in both countries is 40%, payable in arrears. You now come here. Tax on royalty. 40%. Compute 40% of 33 million.
Sir, can we assume the withholding tax rate to be the same as company income tax rates for
That
the
is what
purpose
you are
of this?
going to do.
Okay.
It's an income that has escaped tax. So we have to pay 40%. By 3%, 33 multiplied by 4.0, 13 million approximately.
No,
The
sir,
tax for year one.
Sir, this
to
royalty
be paid in year two.
Sir, this royalty received 33 million. The units produced is 110 units. Multiplied by 300 is not 33.
We are calculating, sir. When you are done, let us know about Femi. 40% of 33 million to be paid in arrears year two. Year also to be paid in arrears. To be paid in arrears. To be paid in arrears. Femi, I hope you are fine now.
I'm fine, it's correct, it's correct.
So when you now want to calculate the tax on royalty receipt, it's going to be in arrears. The one for year one will be paid in year two. The one for year two will be paid in year three. The one for year three will be paid in year four. The one for year four will be paid in year five. Now you have now taken everything in. Now recompute the net cash flow. Recompute net cash flow in Naira. 594,138. What do you have here? This is 20. 142. I hope I'm correct.
Yes, you're correct. 142.
137.
137.
978.
978.
275.
No, it can't be 2. 30 what?
301. Negative 301.
301 negative. You can now introduce your discount factor. I'm now say 13%. Abi, I hope I'm correct.
Yes, sir.
Yeah,
The doctor of Google believed you.
3%.
13%.
13.
In year 0, this is 1. Year 1, please, what do we have?
$0.885 or 0.88.
0.885. Year 2.
0.78.
Year 3.
0.693.
Year 4.
0.613.
Year 5.
0.543.
543. Please get your present value now. 594.
122.
122.
112.
112.
111.
111.
Yeah, 111.
No,
Yes.
year 2. No, the year 2 is 111.
111.
95.
5.
95.
95.
Yeah. 600.
600 and what?
Just 600 random. Negative 163.
163 negative. Please get your MPV. Negative or positive?
Positive 171.
171 million. 171 million. The project is financially viable. From the viewpoint of Google PSC, a Nigerian investor, this project is financially viable. This project is financially viable. You are done with your 18 marks.
We're not done, no, because we did not state our assumptions.
What are the assumptions you want to state now? What are the assumptions? Assumptions. One, cash flows will remain constant will remain constant. Two, the cash flow are assumed to occur at the end of each year. Three, inflation rates between the two countries are assumed to remain constant at 5% and 10% respectively. Yeah, those are the assumptions for this question. Somebody is touching my screen, making mark on my screen. Oh. Requirement B states to further information and analysis that might be useful in the evaluation of this project. Assuming your client is to invest in foreign country, assuming this person is your client, this person is your client, and the person is to invest in another country. You have calculated the project. The project will give us positive NPV. This is financial consideration. What other things will you tell your client to monitor? Your client needs to be aware of the political risk involved. Your clients must be mindful of political risk. Look at it here. No, would it be correct? No, this is not correct. Let me check. Let's just write it. One is political risk. If you are placing your investments in foreign country, political crisis in that country might affect your investment. One is two other factors to be considered. One, impacts of political risk in the foreign country. In the foreign country, two, change in foreign country, change in foreign country economic policy, foreign country economic policy. These two will affect your investment. Within 4 years, there could be changes in There could be changes in the foreign country economic policy. The tax rate may change. It's not guaranteed that the tax rate will remain the same for 4 years. Right. I think we have tried. May God bless the little we do. So, on this note, yes, Pelumi, are you raising up your hand?
Yes, please. Okay, so I have a question. If we are given a question where they don't have a double taxation agreement and there's no tax treaty, is it that we'll first calculate, well, is that we'll first calculate all this one, the way we did it, up onto the net cash flow in dollars, we convert it to Naira, and then the net cash flow in Naira will not still compute tax on it?
Very correct.
Okay, thank you. We'll do the same thing too for
Very
the
correct.
royalty. Okay, then in that way, then that means the royalty, since it wasn't received in the foreign one, will not calculate tax on the royalty. It's when it comes to Nigeria that we calculate. It's just one tax we calculate for royalty received.
Are you done, please?
Yes, I am. Okay.
Now your question is, assuming this same question is repeated. Examiner now says, no double taxation agreement between Nigeria and foreign country. How are you going to treat it? When you get here now, let me go back. When you get here now, you are going to sum these two together. You are going to pay tax on this 105. You also pay tax on this 33. You are going to sum these two together first. Sum these two. You are going to sum these two together now. You now pay tax. So you are going to pay tax on the net cash. Is that better, Pelumi?
Yes, sir, it is. But in the question, just to take you back a bit, I'm so sorry. No, is it because the question says that no withholding tax is levied on royalties payable? Is that why we are using the normal tax rates? I mean, withholding tax is supposed to be like 10% or something. So is that why we are using the 40% on the royalty?
Okay, now I said it also. Even in fact, Ismail asked that question.
Maybe
You
I missed
cannot
it.
bring in your assumption to the question. You
Okay.
cannot bring in your own 10% withholding tax.
Okay.
That income, that royalty is not dividend. It's actually a profit you have received.
Okay.
You are going to apply 40% on it.
Okay.
You know, it's
So,
different from dividend on profits.
okay. So wait, if the question didn't say anything about withholding tax, we would have still applied this 40%.
Very correct. In as much as, you know, when you look at the calculation, look at that calculation. Look at the calculation. You know, by deducting this royalty here, 55 million, that means we didn't tax this money.
Yes.
Even if the examiner has not said anything about no withholding tax on royalty, the examiner is even helping you by telling you. The examiners remain silent. In as much as this money here, you deducted before you compute tax. That means you didn't tax the money. You are still going to pay tax when you get to. Is that better, please?
Okay. Okay. So just to clarify, if the examiner was silent, we would have still computed tax. However, what if the examiner had told us that withholding tax is levied on the royalty?
Oh, this is Pelumi, Abi.
Yes, I'm still the one. I said I understand you.
Okay. Oh, Pelumi.
Sir?
Go ahead.
I understand what you've explained now, although the network took you out at some point, so there was a break in transmission. But if I understand correctly, if the examiner was silent about withholding tax, would have still computed this profit. I understood that explanation. But what if the examiner had told us that withholding tax is levied on this royalty? How do we compute the tax?
You know, the question has changed. Examiner says withholding tax has been levied on royalty payable from foreign country to Nigeria. Is that not?
Yes.
That means that royalty has been taxed in foreign country. In that case, when you get to Nigeria, you are not going to tax it again.
Okay.
That means when you get here now, you just pick your 33 million. 33 million, 33 million, 33 million, 33 million. You won't compute tax again.
Okay, I understand now. Thank you, sir.
I know you like investments. I know. All right. Any other clarification? So on this note.
Sir, wait, sorry. One question. For the working capital that we put in, if I know, Yes, sir. For the working capital that we recouped in the year 4, so are we supposed to state as part of our assumption that working capital is recouped in the final
Are
year?
we supposed to?
State in our assumption that working capital will be recouped in the last
You
year.
can put it there now. You can put as many assumptions as you like.
Okay.
Do you understand? That it is assumed that the working capital will be recouped at the end of the project. Fine, that's fine.
Okay, thank you.
So can I close on the final notes?
Yes, sir. I have a general comment on the exam between you and Mr. Juwon. I think that in looking at the structure of the lectures you have delivered, first of all, I want to say a big thank you to both of you for your diligence and your ability to deliver to this level and quality of delivery. I want to say also that between you and Mr. Juwon, you seem to have omitted dividend policy and capping, capital asset pricing model, assuming that maybe it has been moved to the skills level. But when I looked at the pilot questions, I noticed that this is not the case. That it is in fact still, if you check the pilot question, the examiner is still testing dividend policy and cappings. So I don't know
All right.
how you are going to help us with those two topics, sir. Thank you.
First is, it's not a mistake. Your syllabus, there is no dividend policy. In fact, there is no portfolio theory and capping. However, what ICAN did was that it is assumed that any topics you have in skills level, for you to be in professional level, you have covered that topic. Let me repeat my point. Though the assumption with school and knowledge is that for you to finish primary 1 or for you to finish GSS 1, you have moved to GSS 2. Any topic treated in GSS 1, it's assumed that you know the topic and you are going to carry it along to GSS 2. So it wasn't an omission or a mistake that we didn't take it. In fact, if you look at my students, those that I taught in foundation, those that I taught in skills, the like of Pelumi, I told them, I said, I'm taking you dividend policy in skills level, FM. This dividend policy I'm taking you, you are going to take the knowledge toward professional. This Pelumi was my student at skills level. Obafemi was my student at skills level. We treated dividend policy. So it wasn't an error that we didn't want to take it. It was how your syllabus is designed. There are some topics that are specifically designed for your level. In fact, if examiner will ask you, for your level, we call it advanced financial management. The like of hedging, foreign currency hedging, interest rate hedging, option theories, these are the topics specific for your level, professionals. But for you to be a professional, it is assumed that you have done dividend policy before. You have done CAPM theory before. If we are to go into those topics now, we will not be able to focus on your main syllabus. So for some of us that we didn't do FM skills, you have passed skills level before they introduce FM. What is now going to play out is those topics. If you have enough time, you can just read it along. But if you don't have enough time, you can read the ones that have been treated. What I always tell students is, you are going to have 7 questions. Out of these 7 questions, ICAN can decide to take 6 from professional questions only. It can now take 1 from skills question. Like last diet, they put dividend policy there. I was wondering why. Don't be surprised these days. Examiner can put choice of finance for you. Examiner can tell you, explain the various sources of financing. And this is a topic for skills level. So Mr. Osman, it's not that we don't want to leave it out. So it's the way your syllabus is patterned. Though. We have query ICAN. They say no. In fact, I remember I was at the off record. Let me take this off record. So I'm going to, yes, I have stopped recording.
I don't think you have stopped though.
So I can't discuss this here now because I was at the meeting where we discussed this at ICAN. So Mr. Osman, you can try to read those topics. You can engage us with questions on one-on-one if you have problem with it. But we can't come to that topics here.
Okay, thank you, sir.
All right. So on this final note, I wish all of us the best in our exams. Please watch out very well the dynamics of your exam. If you look at how your exam will pattern between merger, business valuation, investment appraisal, your 30 marks question will be texted. The 30 marks always go between merger, business valuation, investment appraisal, cost of capital. Your 30 marks question, examiner can put it together with like 4 or 5 questions, 4 or 5 topics. Within your cost of capital, examiner can build in bond valuation. You might need to work between hedging, currency hedging, interest rate hedging, and international investment. Then you must also prepare for theoretical questions. Like I explained in the online class on the platform, all those topics Mr. is taking you, the like of risk management. How can you manage risk? Theoretical areas. What is risk? What are the methods of managing risk? How do we assess risk? Your strategic model and management. Strategic management and models. Within those theories, Mr. Ali takes you. You are going to expect 20 marks question from it. So you can plan your strategy in such a way that you pass. So we are accountants. Thank you and God bless. I will be checking out.